In the financial markets, hindsight is forever 20/20, but foresight is legally blind. And thus, for most investors, market timing is a practical and emotional impossibility. This quote by Benjamin Graham explains a hard but difficult to digest fact about the stock markets. Benjamin Graham is known as the father of value investing. He is the teacher of Warren Buffett, who Warren Buffett described as the second most influential person in his life. Hi guys, it's me Vedant, and in this video we're going to be discussing two extremely repetitive words in the world of investing. But before we actually find out what SIP and lump sum are, I think it's extremely fruitful and critical to understand what timing the market means. Buying or selling stocks based on your prediction of whether the market is going to go up or down is known as timing the market. Suppose I predict that the stock market will go very high in the next 1 month and I buy stocks today based off of this prediction. If I am successful, then I can say that I have timed the market. As we discussed in the quote just now, as Benjamin Graham said, that looking back, it is very clear and obvious what was the best thing to do and when to do. But having the foresight about what to do is actually a practical and emotional impossibility. Many investors try to time the market and fail miserably. There are dozens of other legendary investors who all share the same opinion and have given many quotes on how difficult and almost pointless it is to try and time the market. Let us look at how the market was in the last 5 years. As we can see, the market goes through many swings and they're pretty unpredictable in the short span of time. For example, if we had invested around 31st August thinking the market has been in an upswing and it will maintain that, which is an extremely human tendency. We extrapolate what has happened up till now to the future. Therefore, let's assume we have invested a lot of money around the time of 31st August. Unfortunately, looking back now, we can tell that it was a very bad time, in fact, to invest. We would be in actually red and we would be in loss for nearly the next 1.5 years. Common retail investors and beginners like you and me often make this mistake. When we see the market falling, we suddenly panic and sell immediately. And we think that we'll buy when the market goes even lower. But this often doesn't work out. And we often also sell too soon for a very little profit. Well, all these mistakes are extremely natural and probably one has to go through them to recover and learn from it. Now, since we have understood what timing the market is, let's keep that aside and dive into what SIP and lump sum really are. SIP and lump sum are essentially two different methods of investing. SIP and lump sum investments are done through mutual funds. Make sure to check out my video on mutual funds if you are not sure of what mutual funds are. We just discussed that investing too much money at once at any point of time is a problem. Well, how do we get around it? It doesn't mean it can stop us from investing. There has to be some way, and that way is SIP. SIP stands for Systematic Investment Plan. Through SIP, what we do is we invest a fixed amount of money on a particular date of every single month. Let's now look at the pros and cons of it. The number one and biggest pro, according to me, of SIP is that it inculcates financial discipline and also helps you get a control over your expenses. Well, it probably didn't make sense right away, but let me explain. Suppose you're a salaried employee whose salary gets credited into your account on every 8th of every month, let's suppose. Suppose you fix the date of your SIP as 10th. Well, even before you get a chance to spend your salary, you have made sure you have invested a fraction of your salary already. And now you're going to have to learn to survive with the remaining part. I have explained this in detail in the book review that I did of Richest Man in Babylon. Please check it out if you want to know more about it. Now, coming to the second pro. Well, if you haven't already noticed that this helps us avoid the timing of the market problem. Now we can basically buy whether or not the market is high or low. We can keep buying at a fixed interval. What it helps us do is that now we buy whether the market is high or low. It helps us get a lower average value and it helps us take advantage of the compounding that will happen over a long span of time. And now we won't have to worry about whether the market is high or low or any of that issue. Now let's come to the third pro. Well, it is somewhat related to the second pro also. The thing is, now investing has become something in the background for you. You can focus on what your main occupation is and not worry about investments. It is something that just happens like a habit every single month without you having to worry. The last pro I would like to cover from SIP is that we can start with extremely small amounts, as small as 500 rupees per month. This means that even students can easily start investing and do it comfortably. Now, coming to the cons. The averaging that we get from SIP does prevent us from taking losses, but it also prevents us from making huge profits. For example, during March April of 2020, it would make a lot of sense to invest in that massive correction and crash that the market went through. But it takes a lot of emotional stability and rational to actually do that in that moment when all hell has broken loose and nobody knows what is going to happen. Now coming to lump sum. In lump sum, what we do is we invest larger amounts of money at once into the market. And as we discussed before, this has a higher chance of risk as well as reward. If you haven't already started investing, you can open a demat account with Grow, who I use as my broker and have also reviewed on my channel. You can open a demat account using the link below and start investing. That's it for this video guys. Make sure to smash the like button and subscribe if you haven't already.